Hey Nick, how you doing today?
Doing great, Dave. How are you?
I'm doing well. Time to record another podcast. And interesting topic today. The American Rescue Plan passed Congress and was signed by the president week before last. And there's some planning opportunities and some tax complications around that we should talk about.
Yeah, all sorts of stuff going on with that, and it would seem like anytime Congress throws out $1 trillion in stimulus, that it would be something of an exciting, unprecedented time. But we've seen a lot of it lately, so it's kind of a ho hum. Hey, what do we do now?
Yeah.
Since this is the third round, but there's definitely some planning opportunities that we're going to go through today, and some things that you really have to pay attention to, especially if you're close on certain things. So.
Yep. And some opportunities regarding 2020 and some opportunities regarding 2021 as well. So the main item everybody's talking about is the recovery rebate or stimulus check, as you hear it called, which was $1,400 per individual.
Yeah, so that's the big one that I'm sure most people have heard about. It's the biggest part of the plan in general, and from my understanding, a lot of people, if they have direct deposit set up with the IRS, probably already have that in their accounts. So
I had a couple clients that saw theirs middle of the week last week. So
so if nothing else, we're getting good at getting that money out to people once it's approved.
Yeah. And so it's $1,400 per individual. So if your household is you and your spouse, that's $2,800, and then another $1,400 for each dependent. And that's different than the last round of stimulus because it's dependents rather than children.
Yeah. So before it was based on whether or not your child was eligible for the child tax credit, and now it's if they're your dependent. So if you are if you have an older high school senior, or potentially a college student that's still a dependent of yours, that's kind of a big win for you because you're getting $1,400 for them now at this round.
Yep. And the flip side of all of that generosity is that the phase outs based on your adjusted gross income are lower than they were with the last round. And so if you're a single tax filer or if you're married filing singly, the whole thing phases out between $75,000 and $80,000.
Yeah, and that's a big, the big change is that's a big jump, right?
Right.
So before you had a little bit longer where you started getting less at 75, but I think it went up to it was 90 or 100 or something like that. But now basically, if you're over 75, it starts phasing down. If you're at 80, you get nothing.
Yeah.
So that's a much bigger jump, and you have to pay a lot more attention to where you fall in that this time around.
We should add that if you're filing head of household, that phase out is between $112,500 and $120,000, and if you're filing as married filing jointly, it's $150,000 to $160,000. But yes, much steeper. It's more like a cliff than a phase out.
Yeah, so it just brings in a lot more planning that has to be done, especially if you are close to that phase out range.
Right.
And there's also different stages based on how they check and see when you're going to get that money.
Right. And so there's 3 checkpoints, three tests to see whether you qualify. And if you pass any one of these, you qualify, and there's no clawback. The IRS isn't going to come back and say, well, you qualified based on 2019 income, but not based on 2020 or 2021. And so the first thing that they're going to check is your most recent return on file. And for a lot of us, that's still 2019. But if you've already filed your 2020 taxes, they're going to look at that and see what your adjusted gross income was. And if you're below those thresholds, you're already qualified and you don't have to worry about it, and you'll get your payment.
Yeah, so when you're thinking about this and you're thinking about your situation, you might have had a pretty decent year in 2019, but things could have gotten you could have had lower income in 2020. And so you might find yourself in a situation where you wouldn't have qualified based on 2019, but you would qualify based on 2020. And if you have already filed your taxes, you probably are already getting that stimulus. But if you haven't, you won't get to that until you actually file your 2020 taxes, that second kind of checkpoint. And there's actually a date by when you need to do that. I believe it's September, but we will for sure put it in the show notes.
The date as it stands right now, it's the way the law was written, it says 90 days after the tax filing deadline or September 1st, 2021. And I believe since they've kicked the tax filing deadline back to May 17th, that will trigger. So essentially that second checkpoint based on 2020 income, the date you have to file by is September 1st, 2021 to qualify for that.
Yeah, so if you are planning on filing an extension and you do qualify in 2020, you want to make sure you get it done by September, because if you don't file by September, then they're going to base it on your 2021 tax return, even if you qualified in 2020.
So if you qualified based on 2019 or 2020 taxes and you've already filed, you're all set. If you would qualify based on 2020's income but not 2019, make sure you file by September 1st, 2021. And then the third checkpoint is your 2021 income. So if you didn't qualify based on 2019 or 2020 but have lower income for 2021 and you hit those thresholds, you would then get the rebate amount applied to your 2021 taxes.
Right. Yep. So lots of little kind of details in there that you make sure that you're getting with your tax professional, your financial professional on if you're close and you think you might be able to qualify. Especially, if you've got a family of 5, and that's $1,400 per person, you're looking at $7,000 potentially. Yeah. So that and that basically goes from a 7,000 at 150 to 0 at 160 for a family.
Right. So that's a pretty high tax rate on those additional dollars if you're going over those thresholds. And so, there may not be much you can do about 2020 income at this point. You could still make a tax deductible IRA contribution if you're qualified. That would lower your income a little bit. If you're self-employed, you may be able to contribute to a SEP IRA or do something along those lines to get your income down a bit. 2019 is obviously in the books, and 2020 is pretty close to in the books. Not a lot you can do there. But for 2021, there's all kinds of opportunity to make sure your income is low enough if you're close.
Yeah, and that can definitely make a big difference. So if you're on that kind of cliff of 75 for single or 150 for married filing jointly, you definitely want to. The sooner you realize kind of where you're at and where you're going to be in the year, the sooner you can start making those adjustments so that you can qualify.
Right. And we'll come back and talk about some of the planning opportunities here for 2021 at the end, but we should also talk about the child tax credit enhancements that go with all of this.
Yeah, so that's the another big piece of this is if you have a child, the child tax credit has increased from $2,000. And remember, was it 2 years ago that it was $1,000? And then last year we got a bump up to $2,000 with the tax plan that was put into place. And so now for this year only, for 2021 tax year only, it has gone to $3,000 for a child that is 7 to 17. Or if you have a child under 6, it is $3,600 per child. One note on that age 17 is it used to be that you had to be 17 by the end of the year, and now it is 18. So if you happen to have a child that's turning 17 this year, you will still get to file the child tax credit for your 17-year-old, and that is another change in the child tax credit. Yes. And much like the stimulus, there is also phase outs, although they're a little bit more generous. The phase outs start at the same amount. So single 75, had a household 112, married filing jointly 150. And then for each $1,000 that you exceed that, it's $50 less of a credit that you get. Now that applies only to the extra $1,000 or $1,600 tax credit. It does not apply to the standard child tax credit of $2,000. Those phase outs remain unchanged. And I believe married filing jointly is somewhere around $400,000. So much higher for the normal child tax credit.
Yeah, it's pretty interesting. Another interesting aspect of these child tax credit increases is that they're going to make an advance payment on those starting this summer, and that's a little unusual for the tax code.
Yeah, so basically they're going to take 6 months or half of that credit and start paying it out to you in a direct deposit, I suppose, if you have it set up, or check if you don't. So the one thing about the advance payment, though, that you have to be careful about is it is subject to a clawback, unlike the stimulus. So if you find yourself over that 150, you might end up paying some of that back, depending on where you fall tax season wise, because there is clawback on that payment.
Right. And so that's going to be one thing to watch. So there were also some interesting changes and enhancements to unemployment. They extended the extra unemployment benefits through, I believe, September.
Yes.
Yep, through September. And then a new provision for unemployment you may have received during 2020 is that the first $10,200 that you received is tax-free.
Yeah, so that's another interesting one. If you haven't filed, or if you haven't filed your taxes. So if you got unemployment last year and you filed your taxes, chances are, if you did your taxes right, you already paid the taxes on that unemployment.
Right.
So you might actually have to file an amendment to change those so that you're not paying taxes on that unemployment.
Right.
And that is $10,200 per person. So if you're married filing jointly and you both got unemployment, it's actually $20,400 in unemployment tax, or in unemployment income that you won't pay taxes on. Yeah. Now those same phase outs for that, or the phase out is 150 for every
regardless
of your filing status, and that's a hard cliff. So if you're at 150.01, none of that is tax free. If you're at 149.999, all the 20,000 is tax free. And unfortunately, they're including your unemployment compensation in that 150 cliff.
When I first read that, I thought, oh, that's a mistake. They just forgot to add the head of household and the single, and no, that's what it was. So now I'm imagining like the poor clerks that were writing this bill, or the interns in congressional offices who were putting all this stuff, just got tired and just said, just make it all 150. Right. We've been at this for 3 days. Let's just make it 150. It's just easier. So anyway,
another one of those planning things. If you're at that 150 level or close to it, and you got unemployment last year, if there's anything you can do to get under a 150, it could make a huge impact. On paying taxes at that level, at that income range, on $10,000. It's a pretty good chunk of change.
Yeah. What about COBRA subsidies? There were some changes around that too.
Yeah, so this is very interesting. If you're on COBRA, COBRA is your insurance. If you leave your employer and you have health insurance through them, they are required to offer COBRA for 18 months, I want to say.
Yeah, 18 months is the usual limit. Yep.
And so if you're taking advantage of that, what you'll notice is usually you're paying for all of that, and it's much more, it's a higher premium than what you were probably paying your original plan, but they have to provide it for you. And what's happened is, starting April 1st, the government is essentially paying your COBRA premiums through, is it September?
Yes.
Through September. So, and technically your employer is going to pay those, and they're going to get refunded and
reimbursed.
Reimbursed. So either way, if you're on Cobra and you're paying that right now, you will no longer have to make those payments. They will be paid for you. So that's a bit of good news for people that are unemployed. Still have health insurance and not have to pay for it until they can find more permanent.
Yeah, yeah, with the idea that there's a lot of people that may be changing jobs and bouncing around through no fault of their own during the recovery from the pandemic. So there was also, a lot of people have been waiting to see what the new administration is going to do around student loan debt. And there was a little thing in this bill regarding student loans. Any student debt that gets forgiven between 2021 and 2025 will be income tax free. And that's interesting because that's all, so they didn't change any of the forgiveness itself. Those are still based on the same old programs, which, that's a whole, probably 3-hour podcast talk to try to cover all the different ways of student loan forgiveness that's out there. But traditionally, that's been taxed as income when it's been forgiven. So it's kind of a mixed blessing, and they're going to waive that income tax for the next couple of years.
Yeah, a little bit of a break on student loans. Probably not what most people were thinking of. The Biden administration's thrown out the $10,000 of forgiveness, and I know there's some Democratic parties that want that number to be higher. So nothing on that yet to be seen if they get something along those lines done, but a little bit of relief if you have student loan that's going to be forgiven the 2021 through 2025, that forgiveness will be tax-free now.
Right. So then there's a couple notable things other than student loan forgiveness that were not in this bill. There was no relief from required minimum distributions for 2021. And if you recall, in 2020, if you had required minimums from IRA accounts, those were waived. And it makes sense that that wasn't waived for 2021, because the big logic behind not requiring those last year is at the time they made that decision, the markets were under extreme duress, and they were going to force people to sell investments at times when they probably didn't want to in order to take that income. And we saw a good recovery in the market. So not the same logic this year.
Yeah, absolutely. So those were a couple of the things that we thought might be in this bill that were not, that are still kind of on the table at some point, but certainly not part of this American Recovery Act, or the rescue plan, I'm sorry.
Yeah.
And the one other thing that we didn't mention, Dave, that is kind of important as well, especially if you have children, is the child and dependent care tax credit has been enhanced.
Yes.
Quite significantly, actually, I think, from where it was before. And one of the big things out of this that we've been hearing is the need for access to childcare and getting the workforce back. Women have been hit particularly hard with childcare duties and on top of work duties and kind of juggling that. And so this, I think, addresses some of that, at least for the near future, with enhanced child tax credit enhancements. And so if you are taking advantage of child tax credit, child dependent care tax credits, make sure you look at that, because a lot of people would use the flexible spending accounts on that. And so now there's some debate as to whether or not you'd be better with the new enhanced child tax credit or the flexible spending account. So if that's something that you are currently doing, then definitely take a look at those and plan around how to best utilize those, because those, again, can't be used together. So sometimes it makes more sense to do one over the other. So certainly something to look into if you are participating in a plan like that.
Yeah, I'm glad you circled us back to that. I almost missed it. Then there was also talk around a cost of living adjustment to retirement plan contributions. That was not included in this bill. May still happen at some point. And there was also a lot of debate, and held the bill up for a little bit, around an increase to minimum wage.
Yeah, so those both weren't in there. That doesn't mean that it won't happen. It just means that it's not a part of this plan. So we'll wait to see what else happens and what other legislation comes out of this new administration. So, but for now, no cost of living adjustments or minimum wage hikes.
Yeah. Yeah. So some planning points. Again, if you're near those thresholds for 2020's income, you may want to talk to your tax advisor, your financial planner, and see if you can make a deductible IRA contribution for last year still, or a contribution to a self-employed retirement plan. Do something to get your income below those thresholds for 2020. If you're on the bubble for 2021, there's a lot more that you can still do at this point in the year.
Yeah, definitely. And if you're close, just to give you an example, this is kind of an extreme example, but let's just go out and say that you're married, filing jointly, you've got 3 kids. And you're making, you plan in 2021 to make 160,000. Right?
Mm-hmm.
So a little over the threshold for the phase out. Well, if you didn't qualify for the stimulus based on 2020, that's $7,000 of stimulus money plus an extra $1,000 for each kid. We're going to assume they're over 7. So that's $10,000 that you would be earning, essentially, you would be getting in order to reducing your income from 160 to 150. Right. So there's a couple of different ways to accomplish that in 2021. One would be to make deductible IRA contributions, or to make 401k contributions of an excess of 10,000 to get yourself to below that 150. So if you think of it that way, you put $10,000 in your 401k, and then the government turns around and gives you a $10,000 check at tax.
You still have the $10,000 in your 401k, and you'll be thankful for it, 20 years later in retirement. Yeah. So it's a winning situation.
And so another way to think about it as well is to really start to get creative and think outside the box. Let's say that you're on track for retirement, because again, we're financial planners, so we're not going to tell you to not contribute to your 401k unless you're on track. Well, let's say you are. Let's say you're feeling good about retirement. What if you went to your employer and just said, hey, I want to take the last 6 weeks of the year off. I don't want you to pay me. I want to not take that income, or maybe even defer some of that income. So you take 6 weeks off, you end up getting $12,000, $13,000 less based on your 160 AGI, and then the IRS gives you a check for $10,000 next year because you took 6 weeks of work off. So another way to creatively think outside the box in terms
I'm not sure if how that'll work for stimulating the economy, but we won't ask Congress to answer that question for us. Some less creative, more conventional things to think about. If you're splitting say you're making a pretty healthy 401k contribution, but you're putting some of that into a Roth IRA instead of traditional IRA. In a lot of situations, we like that Roth contribution, but if Roth contributions don't lower your adjusted gross income. So if you swap that and maybe make that a tax deferred, a traditional contribution for this year, that may get you underneath the limits too. So if you're anywhere close to those limits, the bottom line is if you're anywhere close to those limits, you really want to look at what you might want to do to reduce your income for 2021.
Yeah, it's just such a huge cliff and such a short window that if you're close and you can get under, chances are you're going to be in the same position income-wise, or even better off by reducing some income for 2021.
Yeah. And, and things like a lot of the time we talk to clients about Roth conversions later in the year and taking capital gains on investments this year as opposed to deferring them and seeing what makes the most sense. And we do a tax projection for that for the year. Well, our programmers that handle that software for us, I guess they were scrambling around the last 10 days. They were pretty excited this morning to announce that they had all these new rules baked into the software. And I'll bet that that's probably the case with the software that most CPAs and accountants are using too. So, this can all be built into those assumptions when we go forward this year. And you've got 8 months yet to control your income for 2021.
Yeah, so definitely be proactive about it, because if you're going to change your income, let's say you want to put an extra $10,000 in your 401k, it's easier to do it 1 month at a time than it is to come to December and try to make 100% of your compensation into a contribution. Isn't as easy as doing $1,000 a month. So think about think about ways to make those changes now so you can spread it out over time, because you're not going to, if you're thinking about being able to qualify for the stimulus plus the extra child tax credit, you're not going to get that money until you file your taxes.
Right.
So, that's for most people February, March, April-ish. So it's going to take some time to get that money back. So just be prepared for that if you're thinking about making some extra contributions this year.
Right. Think big picture, but there's some pretty significant tax dollars at stake here. So it's at least worth having that conversation with your planner, your tax advisor, your boss, if you're going to ask for a month or two off,
Yeah. Exactly. So, and the other thing too, if you have year-end bonuses, a lot of times, sometimes you can get them pushed into a different year.
Push it into the next year. Yeah.
You don't necessarily have to take 6 weeks off. I'm gonna get emails now from bosses.
Right.
Why is my employee telling me they're gonna take 6 weeks off?
Thanks, Nick. Yeah. So yeah, and I guess the last thing to mention here is that this all is temporary for right now. I guess that's the definition of temporary. But there is some talk of these items that are tax related being things that the current administration and the Democrats in Congress would like to see made more permanent. So, stay tuned. We'll see what comes. But for now, it's 2020 and 2021.
Yeah, this is definitely not the last we've heard of some of this stuff. And I would just say it's just more important than ever, especially if you're close to these numbers, to be doing tax planning, whether that, so oftentimes we get stuck into this. We don't think about taxes until we're doing taxes. And the reality is that's why a lot of people are sitting, and this is a unique situation because we didn't know about these changes until now. So it's hard to change last year, but this year we know about them. So you should be doing tax planning with your tax preparer, with your financial planner. You should be looking at where you're going to fall this year and making those adjustments now, because once it comes to this time next year, you have limited options when it comes to what you're able to do than you do right now. So just think about that, be proactive, and definitely if you have questions about it or your specific situation, feel free to reach out. We'd love to chat with you.
Yeah, and it's always a scramble when they change the tax code, but I guess we chalk that up to job security, right?
That's right. That's why we're here.
All right.
Stuff like this.
Thanks, Nick, and I'll talk to you later.
All right. Always a pleasure, Dave.